What's up, you guys? I'm Dan, this is Frugal Not Cheap, and today I'll share my investment philosophy with you. So a few weeks ago, a commenter named Azam987564321 asked about my total return approach to investing as a comment on my I have a small emergency fund video. This commenter asked me about how I mitigate risk, if I'm doing any kind of hedging, long and short position management, and my overall investment thesis. And so this got me thinking about the answer, and I thought about really taking each of those points in turn, but then I realized because my investment strategy is so simple that a lot of them addressing those points individually really might not make all that much sense. But I've given you bits and pieces of my investment philosophy over time if you just go over my growing catalog of videos. But anyway, over time, you've gotten a little bit of sense of it, but I don't think I've ever really kind of gone out and spelt it out in detail. So that's what we're going to do today, just go over my investment philosophy. And again, it is a very simple philosophy, and I think one way that we can really boil it down is just to the following phrase, which is, I don't know. So really, my investment philosophy is, I don't know, because I don't have a crystal ball. There's just no way to get perfect information about everything. And even if I did, actors in the market aren't necessarily always rational in the short run. So yeah, I don't know. I think, well, we'll talk about it more as we go through, but basically that is my investment philosophy. So let's kind of start with sort of a blank slate and see how this works out. So the idea is, all right, let's say that I want to start investing. So the first question we might ask ourselves is, which stock should we buy? And the answer to that is, I don't know, because there's tons of what are called active fund managers out there. People who are professionals trying to pick stocks and trying to develop a portfolio of those stocks that's going to outperform the market. In other words, generate some alpha. A couple of guys, Larry Swedroe and Andrew Burkin, have put together a book recently called The Incredible Shrinking Alpha. In other words, that this outperformance of the market is becoming rarer and rarer. And they note that in this study by Dow Jones, that Dow Jones actually puts out every year, over a period of 10 years, 85% of large cap funds fail to generate any alpha against the S&P 500. And of course, the S&P 500 are the 500's largest. So this is the appropriate index to, benchmark these large cap funds against. And again, these are these active professional managers that are supposed to be picking the best stocks and thereby beating the market. So 85% of them can't do that over a period of 10 years. And if we zoom out to 15 years, then we find that 92% of them cannot beat the index. So then you might say, all right, what about those 8%, right? There are some 8% that are able to beat the market. And research has shown, I would argue, that most of that, obviously there is some skill to be put into the runnings at all. However, what really generates that alpha, in my view, is really mostly luck. There are some situations like in high frequency trading where we can actually take advantage of asymmetries in the market or advantages that we can generate in the market and thereby create some benefit. But these are very highly specialized scenarios. So generally, just as the average guy, I believe in passive investing rather than active investing, because I don't know which are the stocks that are going to win. And in fact, as we can see here, the professionals have no idea which are the stocks that are going to be outperforming either. Now, some of you longtime viewers might be wondering, well, hey, Dan, you do own a couple of individual stocks, and those individual stocks have been performing quite well. What's up with that? Well, I bought a single Class B share of Berkshire Hathaway in order to get a discount on my Geico car insurance. So I don't think, this was just a great way to get a discount by owning an asset. And this asset has returned just under 28% gain since the time that I bought it. So that's doing pretty well, pretty happy with that. The other one is that I've been a long-term Tesla fan. I bought a Tesla vehicle last year used. Really continue to love that car. Not perfect, but pretty freaking amazing. So I thought, I believe in this company and its mission. I thought that it could do well, and I figured I could spend $1,000, a little over $1,000 in birthday money, just to put my money where my mouth is on the stock and see what happens. And I'm seeing a gain of 1,357%. At the peak, that gain was over 2,000%, I think 2,300%. And I do, still believe in this company, and yeah, fingers crossed they're going to be able to execute on their plans, which are really ambitious. And who knows, this gain might be even higher in the future. Okay, so I'm saying, I don't know, in terms of picking these individual stocks. And also, I believe that the investment managers, these hedge fund guys, and also mutual fund managers for active funds, they don't know either. So that means that I'm going to be investing in passive index funds. So then you might ask yourself, well, okay, Dan, there are a bunch of factors or sectors that we might want to look at in terms of these mutual funds or index funds, right? So am I going to invest in basic materials? Am I going to invest in technology? Should we invest in real estate? And again, my answer is, I don't know. So I just buy the entire market, because again, research shows that sometimes certain sectors outperform others, but it's anybody's guess which is going to be the strongly performing sector at any given time. And what tends to happen in investor psychology is, you jump on a stock or a sector or factor that's doing well at the time. Sometimes this can work out in terms of momentum, but the problem is you don't know when to get out and move to the next one that's going to be doing well. And so it's really just a fool's errand trying to chase all this stuff. Maybe you can get lucky, absolutely you could, and make some money, but in the long run, my view and the data shows that just buying the overall index is the better bet. So, which index? A lot of people here in the States are into the S&P 500. For me, I don't know that there's any reason to believe that these 500 largest companies that fit the S&P inclusion criteria are going to be the best ones to invest with in the entire country. So I buy Vanguard's total stock market index. If I wasn't with Vanguard, I'd buy, an analog at Schwab or Fidelity. Just buy the whole market on a market capitalization weighted basis. And I think this is really the best way to go for me, because any companies that do well are brought into the index. If they do poorly, they fall out of the index. It's therefore self-cleaning, and it gives you a broad representation of the whole US stock market. It means tons of diversification, but over the long run, still very good returns. So that takes care of which stocks we're going to buy. It all takes care of which sectors. The answer is, I don't know. So we get all the stocks on a market cap weighted basis here in the US. But then you ask, well, Dan, the US is not the only stock market in the world, right? We have, markets in Germany and France and Australia and Tokyo, well, Japan, I was doing countries, and Shanghai, in China, and so on and so forth. So again, which of these is going to be the dominant player over the next 5 years, 10 years, 20 years? And the answer is, I don't know. So I just buy the total global market. Now, the US share of the total global market does tend to fluctuate, and you really lose any benefits of rebalancing if you just completely always follow that. Although maybe I should. But anyway, for right now, for whatever reasons, I'm at 50-50, which I think is, pretty close to sort of the average US global share of the global market over, in recent history. So that's not a bad place to be, again, because I don't know which countries or which markets are going to be the strong ones over the next 5, 10, 15, 20 years. Again, I don't know. All right, so now the last thing, of course, is, well, Dan, we talked entirely about stocks. What about other asset classes? What about commodities? What about bonds, et cetera, et cetera? And here, really, it just comes down to sort of my preferences and risk tolerances. I personally don't care for owning inert things that don't produce anything. So I want to buy companies. I don't really care to own gold or silver or copper. You might feel completely different about that and want to have a more diversified portfolio. Totally cool. In terms of bonds, I found that, with this 25-30% drop that we've seen in the market this year, just continue to stay the course. I'm not freaking out, not panic selling. I've known that from doing a little bit of swing trading on my own in the past, just really got a good idea of how I am in these kinds of scenarios. And so I'm very comfortable, especially because I'm in the accumulation phase. I'm still working. My work provides cash flows on a consistent basis. And so I'm really in a position where I'm very comfortable holding a very, very risky allocation of 100% stocks, 0% bonds. This could be very, very different for you, of course. Your risk tolerance might be very different, and that should lead you to have a different ideal portfolio as well. And then one last question you might ask is, all right, Dan, so you're fine being 100% equities, right now, but hey, isn't there a lot of news on, right now about there being a recession coming, cataclysm, and who knows what's going to happen in the future? And again, there my answer is, I don't know. Maybe all this stuff will happen, maybe it won't, but whatever happens, I'm going to continue to stick to my long-term strategy, which is 100% equities, again, global market cap weights, buying the total market indexes both in the US and abroad, and consistently buying as soon as cash flow comes in. I'm investing on a weekly basis as my cash flows come in, and that's the plan that I'm going to stick to, and I won't deviate on it based off of any short-term factors that are happening, because that just doesn't make sense. My investment philosophy isn't going to change just based on what's in the news this week or next week. There are many times when analysts or journalists have thought that there'd been a paradigm shift and things are different, but at the end of the day, in my view, owning shares in companies that produce products or goods and services that are then sold to customers, as long as that continues, there's just no scenario under which that's not going to make any sense anymore until we get to sort of a post scarcity world, and there I think about Optimus and about 100% renewable energy and robot labor and artificial intelligence, but that's a whole nother realm. No idea when we're going to get there or if we're going to get there. There's some possible dystopian elements there too, also really, really utopian ones. I might do a video about that in the future, but for now anyway, that's really my investment philosophy in a nutshell. Is I don't know. And so I do this this passive global market cap weighted portfolio. Hope you found that helpful. If you did, please hit the like button and consider subscribing. Thank you very much for watching, and I will see you in the next video.